My name is Amin, and for my topic, I picked Income Tax and Amortization, CRA. What is CRA? CRA stands for the Canada Revenue Agency, which is Canada's federal tax agency responsible for administering tax laws in the context of accounting. CRA plays a role in determining how businesses can amortize certain assets for tax purposes. What method does a CRA require a company to use? The CRA requires companies to use the declining balance method. This method allows for higher deductions in the early years of an asset's useful life. The CRA typically specifies the declining balance rate that should be used for each type of asset. For example, a 30% declining balance rate means that a company can deduct 30% of the asset's underappreciated amount each year. How does CRA relate to amortization? Amortization is the process of spreading the cost of an intangible asset, such as patents or trademarks, or a tangible asset with a finite useful life, such as machinery or buildings, over that asset's useful life. It's similar to depreciation, but specifically applies to intangible assets. Tax deductions. The CRA allows businesses to deduct amortization expenses from their taxable income. When a business purchases long-term assets like buildings, machinery, or intangible assets, it typically amortizes these assets over their useful life. The amortization expense is deducted from the business's income on their tax return, reducing the taxable income and consequently the tax liability. What is CCA? CCA, or capital cost allowance, is a similar concept in Canadian tax law. It refers to the depreciation expense that businesses can claim for tax purposes. CCA rates vary depending on class of assets. Example of asset classes in their CCA rates include Class 10, which is vehicles, which have a CC rate of 30%, Class 8, which is buildings, which have a CCA rate of 4%, and Class 43.1, which is clean energy equipment, which also has a CCA rate of 30%. How to calculate it? To calculate CCA using the declining balance method, the formula varies for different classes. You start with the asset's initial cost, apply the CCA rate for that class, and then subtract any previous CCA claimed. For example, let's say a company purchases a truck for $50,000 in Class 10, which is a 30% CCA rate. The declining balance formula would be initial cost times CCA rate minus previous CCA. So when we use that formula for this, we would do 50,000 times 30% minus 10,000, which would give us 5,000. And there's also an alternative way of calculating CCA, particularly for tax purposes, besides the declining balance method, which is commonly used in Canada. There's also the straight line method for CCA. The straight line method for CCA spreads the cost of an asset evenly over its useful life, similar to how the straight line method is used for amortization. This method can simplify calculations and provide a more consistent tax deduction each year compared to the declining balance method, which front loads deductions. In the straight line method for CCA, the formula is straightforward. CCA equals initial cost minus residual value divided by useful life. And the formula for useful life is initial cost minus residual value. This method divides the depreciable cost equally over the asset's useful life, resulting in a stable CCA deduction each year. However, it may not provide as significant tax benefits in the early years of asset use compared to the declining balance method. Does it produce an increasing, decreasing, or stable amortization amount? The method you choose for amortization or CCA can result in stable, increasing, or decreasing amortization expense over an asset's useful life. The straight line method produces a stable amortization expense, while the declining balance results in decreasing amortization expense. Amortization examples. So we have a company, Tech Innovations Incorporated. The asset is a patent for a software algorithm. The initial cost of the patent is $50,000, and the useful life of the patent is 10 years. On the amortization method we're going to be using is declining balance. So let's calculate the annual amortization expense for Tech Innovations Incorporated's patent using the declining balance method, assuming a CCA rate of 20% for Class 14, which includes patents. So CCA equals initial cost times CCA rate. So we would do $50,000 times 20%, which would give us $10,000. So since this is the first year and there's no previous CCA claimed, the full CCA amount of $10,000 can be claimed. However, for the declining balance method, we typically apply the CCA to the underappreciated cost of the asset, which is the initial cost minus any previous CCA claimed. And finally, what do we do if an asset is purchased throughout the year? If an asset is purchased throughout the year, you typically calculate amortization or CCA based on the portion of the year the asset was in use. For example, if a truck was purchased on July 1st, you would calculate half of the annual amortization or CCA for that year. And that was it for my project. Thank you for listening.